Hi guys, good afternoon and welcome to the CNBC TV18 Mumbai News Center. I'm Pavitra Parekh. With me is Sonal Bhutra. You guys are tuned in the Mutual Fund Corner and there's a lot that we have to talk about today. And for that, we have Mrin Agarwal, financial educator, as well as FinSafe India to discuss capital gains on mutual funds. And a little later, we will also talk about the pros and cons of investing via the SIP route and how this really works versus a lump sum investment. So, Sonal, lots lined up on the show today.
Yes, and it has been a buzzing week, right, when it comes to mutual funds, SIPs. So let's take this conversation forward with the expert on our show. And Mrin, good afternoon. Thanks a lot for joining us. That really takes me to the first question. Since we are discussing taxation, we have had these conversations around simplifying the taxation rates when it comes to capital gains. So before that, let's just talk about what are the current rates for different kind of mutual funds and what is the difference between taxation on, say, listed debt securities, debt mutual funds, because they have been in vogue as well.
So good afternoon, Sonal and Pavitra. Lovely to be on MF Corner today. And yes, there is a different set of taxation for different asset classes held under mutual funds. It can get a little confusing for investors. So first off, of course, on the equity funds, essentially funds which have more than 65% invested in equities, classify as equity funds. And for those, if you exit below a year, it is treated as short-term capital gains and taxed at 15%. And if you exit after a year, then you are taxed at 10% long-term capital gains post a gain of 1 lakh rupees. So that's on the equity side. Now, when we look on the debt side, the taxation is different. So firstly, to qualify for long-term capital gains, you need to hold a debt fund for 3 years. And if you exit before 3 years, it is qualified as short-term capital gains and it is taxable at slab. So whatever the slab rate that the investor comes under, it is taxed like that. Now, for investments that are held above 36 months, it is taxed as long-term capital gains, which is 20% with indexation. And indexation basically allows you to account for inflation in the investment period, right? So it's a little complicated because, investors kind of find it a little difficult to figure out what indexation to apply and stuff like that. Now, when we look at the listed debt securities, to qualify for long-term capital gains, you need to invest for more than 1 year over there, and the taxation is only 10%. So there is an anomaly here because listed debt securities, 1 year, 10%, whereas debt mutual funds, 3 years and 20% with indexation. Clearly there is an anomaly on a similar sort of instrument in both the cases.
All right, that is broadly how mutual funds are taxed and also how it could differ for a short-term investor versus a long-term investor. Mrin, every time we put out a question box asking people to send in their queries, one that we get very often is how does the taxation differ for NRIs? I think there's like a lot of confusion around this topic. So if you could take us through that as well.
So very clearly for NRIs, there is a tax deduction at source. And so in case of, for example, short-term capital gains on debt funds, the tax deduction is 30%. And on long-term, it is basically 20%, right? So essentially what happens is that there is a tax deduction at source for NRIs, and that's where the differentiation is going to happen.
So there is, of course, the point of uniformity that needs to be brought in. So according to you, Mrin, what needs to be tweaked? We have been talking about a number of rates and capital gains tax. Which part of it needs some amendment, and what would you suggest?
Yeah, I think there needs to be standardization of capital gain rates across asset classes. So, for example, right now on property, the holding period is 2 years. For gold, it's 2 years. But gold ETF, for example, is 3 years. So, what is happening right now is that for every asset class, the long-term capital gains holding period differs, and it causes a lot of confusion in people's minds. The other thing is also that somewhere because of the fact that, tax can always act as a good nudge to also get very good disciplined behavior as well. And since equity investing is long-term in nature, ideally, the capital gains on equity, it should be treated as long-term, typically after 3 years and not after 1 year. So I really feel that what needs to be changed is that for debt, you have a shorter period in order to classify for long-term capital gains, which could be 1 year or 2 years. And for equity, clearly it needs to be 3 years and above. And I really feel that that's very, very important to drive good investment behavior as well.
Yeah, we actually have seen a lot of these in the budget proposal and the budget wish list from AMFI as well. Mrin, the other topic that we have been talking about is interest scheme switches, or, just basically switching of your investment within the same mutual fund scheme. In many cases, it is considered as a transfer, and then there is a tax component, of course. So take us through what really happens in this case, and what do you think requires change here? Because AMFI once again has proposed changes to this part as well.
Yes. So, for example, if you switch from a regular to direct plan and vice versa, or if you switch from dividend to growth and vice versa, because of the difference in the NAV, there is a transferability that comes into place, due to which it is liable for taxation, basically. Now, I think the point is that given the fact that you're in the same scheme, but you're just choosing a different plan, ideally, there should not be any tax that should be applied on such a transaction. So, if I were to look at an instrument like NPS, for example, where you can do switches and stuff like that, so you can move from equity to bonds and stuff like that, and there is no tax applicable on that. So I think there should be parity in all of these instruments. And given that, you're in the same scheme and hence there are not really realized gains, ideally, it should not be taxed.
Exactly. It's just a transfer from one scheme to the other. There's not much of a earning that's happening here. Amrin, there is an equity-linked investment scheme in place, ELSS, so to say. You enjoy a tax benefit here. It's locked in for a bit. That's for the equity part of it. For debt also, do you think there should be something like DLSS or debt-linked savings scheme where there are tax benefits? Would you think that would help the debt markets? But the only issue would be it would be locked for 3 years. And if interest rates are locked here, that could be an issue. How do we address this? Do you think that would be the right way to go about it?
I don't see the lock-in as an issue, because when you look at the whole target maturity fund space, you're getting a lot of good flows that are happening, right? So I think investors do like, instruments that are locked in, where they have a fair idea about, what are the sort of returns that it could generate. So I don't really see the lock-in as being an issue. And sure, I think, such a scheme would certainly help in deepening the bond markets to an extent. And it will also give investors an additional option if they want to invest just for a 3-year period. So please remember that while the ELSS comes with a 3-year lock-in, the ideal period of holding is much longer. So there could be investors who want to look at shorter term investments for their ATC investments, and where the lock-in period could be whatever it is, but the ideal period of holding is also short term in nature.
All right. That is on what a debt-linked savings schemes could look like. But Mrin, with the budget pretty close, do you think there are any other suggestions that you have, or any kind of wish list which you think would help investors at large?
Yeah, I mean, I did see the whole suggestion on the retirement schemes. And of course, I think we've seen these suggestions earlier. But, to my mind, every investor has two goals, common goals. One is retirement and the other is child education. And as we all know that the inflation on child education is more than 10%, just the absolute amount that you need to save for child education is so high. And I really think that we need a scheme equivalent of maybe like an NPS in the child education space, which can easily be fulfilled through the child education plans that already exist through the mutual funds. So, a scheme where you invest, you get some sort of an additional tax deduction over and above ATC, because let's remember that ATC 1.5 lakhs, I don't think it's been revised for over a decade. So clearly, whatever else needs to be done needs to be over and above it. So point number one, a scheme where you get a tax deduction to save for child education. And if the payment is used, and obviously have restrictions so that payments can be only used for, or withdrawals can only be for payment of fees, and such withdrawals should be tax-free. Because I think it's a little unfair that you invest tax-paid money and then you're again paying tax on the gains to pay fees and everything. So I think, it'll really help investors. We do have a similar thing in properties where you can sell a property and you can save the capital gains tax by reinvesting in another property. I think a plan like this would really help, the masses. I mean, it'll help citizens across India, right? It'll help everybody because everybody has this goal.
Oh, yes, they do. And that has been the big talking point, raising the ATC limit. We've been talking about capital gains uniformity as well. We'll keep discussing that. Mrin, hold on. We have more to discuss with you. We'll slip into a short break now. On the other side, we'll talk about advantages of SIP and its disadvantages against a lump sum investment. Stay tuned.
Welcome back. You're still tuned into Mutual Fund Corner on CNBC TV 18. And let's now talk about the SIP route for investing into mutual funds. This is a good week for that, right? There's been so much talk about SIPs. And remember, these have been consistently moving higher. A figure that we have spoken about quite often is the inflows, through this category, which have been steadily increasing. In fact, for the month of October, they've also crossed that 13,000 crore mark. I'm going to throw another big figure at you, which is the total SIP assets under management. This has gone up from 5.5 lakh crore. This is what we had in June. That chart is up on your screen. And now it's at 6.6 lakh crore. This is for the month of October. So that's a big increase in just 4 months, right? So let's now talk about this way of investing, the advantages, the disadvantages, and when does this really make best sense? So still with us to take all of our questions, we have Mrin Agarwal to answer these. Mrin, we have been talking about SIPs so much, and with the market sitting at fresh highs like we are currently, do you think this route makes more sense than, perhaps going in with a lump sum investment at such a high level?
Oh, absolutely, and I think, this whole thing about SIP and lump sum, I think, is more dependent upon what the investor is more at ease with. The second thing that I always believe is that if your holding is long term, which is, let's say, 10 to 15 years, I don't really think that there's going to be a very big material difference between the returns as well. It's just that in SIP, you're probably averaging out your cost and stuff like that, right? So again, when you look at SIPs that have been started at peaks also, for example, you still find when you look at their values as of November 1st, for example, you still find, for example, SIP started in March 2000 has still given you a XIRR of 13%. Similarly, SIP started in 2008 at the peak has still given you an XIRR of 12%. So I certainly believe that, yes, SIP is the way to go. And, the difference in the SIP and lump sum is really dependent upon what you're more comfortable with. But clearly, one thing that's common in both of them is that you really need to have this long-term holding if you're investing right now, because you're investing at the peak. So clearly, long-term holding always helps.
So it's long-term holdings, definitely. But right now, we are at record highs. You're talking about higher SIP or lump sum. It can be either of the cases. But when does it change when markets are seeing a big fall? There are the lows. Does lump sum make more sense at that point in time, or it remains the same?
Yeah, certainly lump sum is going to make more sense at that time, or even if you have some extra amount of money that you can add to your SIP also is going to help. So for example, I would think, like, when I looked at some of the past returns during some specific periods, what I do see is that there is about a 25% difference in the returns that you could get by doing some of these tactical calls. But the whole point is that personal finance is 80% behavior, and the point is that when the markets are down, people actually tend to pull out their SIPs. They don't want to add in more money at that point in time. So somewhere, it's great that we are seeing these sort of flows, and it's great that people are choosing SIPs over buying Mercedes. But I think what's really important is that if the markets fall tomorrow, it's very important to not only remain invested, but at the same time, add in some amount at that point in time.
All right. That would, of course, serve you well in the long term, right? If you do choose to add in some money even when the market is at the lows. Mrin, another topic and another group that we try to cater to a lot is this entire batch of new investors, perhaps not so educated, they're still learning. Do you think SIP is perhaps a good approach for them? They don't have to make that commitment of putting in such a large chunk at one point, and they can slowly and steadily build up their portfolio.
Yes, absolutely. And it provides a great learning experience. It also provides, another very important behavior, which is disciplined investing. So yes, certainly I believe that, SIP is a good way to start when you start investing.
Okay, so point taken there, but that takes me to the next question, and that's what we've been trying to, make a conclusion of. Of course, it remains inconclusive, but what are the advantages versus disadvantages of SIP investing? The coin has two sides definitely here as well.
Yeah, I think advantages everybody knows, ease of investing and averaging out your cost and everything. I think, there could be one or two disadvantages. And one could be that, while you average out your cost, you might also average out your returns as well. And it's kind of very point to point, very specific points, and it really depends upon when did you enter and when did you exit. Also, the second thing is that I think if you want to stop your SIP or if you want to change your SIP, some of the processes around these still remain a little cumbersome. And maybe you don't have ability to switch between SIPs. That's another thing that's not there. But clearly the advantages far, far, far outweigh the disadvantages.
All right, that point is definitely well taken. There are many, many more advantages to this than disadvantages. Mrind, how would you say someone should sit and assess which one works better for them? It cannot be based on just how much you can afford, right? Do you think age also plays a factor, or perhaps how soon you would need to withdraw your sort of investments in these? How would you assess which one is better for you?
I would actually go by my holding period, point number one.
Yeah.
So if my holding period is long term, and also the percentage of capital that I am deploying, right, as a portion of my overall portfolio, if it is not all that significant, right? So if it's let's say less than 5%, then I would certainly, think that it's okay to do the lump sum. But I think what's very, very important to keep in mind is that you need to remember that when you do a lump sum, there could be a lot of volatility along the way. And you really need to be ready to see those, bad numbers as well, right? It might hit you a lot more than if you invested through a SIP, right? So you need to be ready for that, and you need to be ready to take that in your stride. But it's clearly dependent upon the holding period. And again, it's dependent upon, what you're more comfortable with. Do you want to split it out in 5 tranches? Do you want to, put it at one shot and just shut it and forget it? It really depends on that as well.
Okay, so, there has been a lot of talk, and this has been a trending story about Mercedes marketing head talking about how they are not able to sell luxury cars because there is a lot of investment happening in SIP as well. Do you think, yes, going forward, this 13,000 crore numbers, of course, the equity cult is building as well. Right now, just a general idea, which funds make the most amount of sense? We're talking about rising interest rates as well. Do you think debt funds is the right way to look at? Or now that we are talking about interest rates plateauing, we should have a mix of both?
I think it's completely dependent upon what your financial goal is. So if your financial goal is certainly long-term in nature, stick with equities. The market is always seeing higher lows and the market is always seeing higher highs, right? So I think it's important that you stick with the asset class that goes well with your goal and your risk profile. And, every time to keep changing between equity and debt based on market conditions is not going to be a very easy way for most people to actually manage their portfolio, right? So I would still, continue to invest in my equity SIPs because my goals are long-term in nature, and use debt funds for my shorter term goals. And typically in debt funds, you could go with a lump sum.
All right, Mrind, how do you expect this to move from here? Currently, we're at 13,000 crores. Where do you see it, say, by the end of this year?
I don't know I cannot predict on the numbers, but, what I'm really happy about is the continuous flows. And I'm really happy because we also get a lot of interest and a lot of in our sessions on SIP. And I do see a lot of new investors wanting to do this. And somewhere, if you look at all the alternate products that came out in the last 2 years, of course, we've seen this big meltdown in crypto. And a lot of the other products also that we saw, I do see that people are kind of now saying, okay, let me get back to the SIP. So that's a good positive sign.
It is. It definitely is. Mrind, it was a pleasure speaking with you. Thank you so much for joining us today and discussing a variety of issues, be it taxation on mutual funds, which is calling for uniformity to the SIP flows, which has been the big talking point, right, this time around, Pavitra. But it's a thank you from Pavitra and me for joining us today on the show.